Good morning. I'm Mary Kane, President and CEO of the Maryland Chamber of Commerce. Welcome to our webinar, Understanding Global Fuel Markets, featuring experts from the American Petroleum Institute. In today's webinar, we will discuss global and U.S. economic developments in context with the markets for oil and natural gas, current geopolitical developments, and regional petroleum supply issues. The American Petroleum Institute is the largest U.S. trade association for the oil and natural gas industry. API's nearly 600 members produce, process, and distribute most of the nation's energy, which makes them the perfect partner to present today's topic as we all try to understand what is going on with today's fuel markets. I am thrilled to welcome API's Chief Economist, Dr. Dean Foreman. Dr. Foreman is an expert in the economics and markets for oil, natural gas, and power with more than 2 decades of industry experience, including ExxonMobil, Talisman Energy, Sasol, and Saudi Aramco in forecasting and market analysis, corporate strategic planning, and risk management. He is known for knowledge of energy markets and applying advanced analytics to assess risk in these markets. Thank you for being with us, Dr. Foreman. Now, I'd also like to welcome Rob Jennings, Policy Advisor on API's Natural Gas Markets team. In this role, Rob advocates for the continued and expanded use of natural gas in the U.S. and abroad. In addition, he also supports API's efforts related to emerging and innovative technologies like hydrogen, differentiated natural gas, renewable natural gas, and carbon capture. Prior to joining API in 2021, Rob spent 10 years in power and gas market consulting at Energy Ventures Analysis Incorporated. Dean and Ron are going to take it away, but please feel free to enter your questions into the Q&A, and we will do our best to answer them as time allows at the end of the presentation. So thank you for being with us, Dean and Rob, and we are all eager to hear your valuable insight.
Thanks, Mary. I'm going to share a screen here, if that's all right.
Yes, please.
Okay. And hopefully you're seeing now, yes?
Mm-hmm.
Okay.
Yes.
So great introduction. Thanks so much. Thanks for having us. And we are an advocacy organization for the industry, but in addition to that, we're a standard-setting organization for over 100 years. And a lot of people don't realize we're also a primary data source on the industry. So we survey over 90% of the industry each week. And this is things like the supply, the demand, the trade, the inventories of crude oil, of natural gas liquids, of every major refined product. And we put these data out on inventory levels, for example, 1 day ahead of EIA, the U.S. Energy Information Administration, each week, and then 2 months ahead of EIA on a monthly basis. And all this is freely available on our website. We also put it in context with the broader economy, oil markets, and natural gas markets, some petrochemical feedstock markets. I'm going to share a subset of that with you here today, and that's this presentation. The summary right now, if you were looking at the headlines this morning, you've seen in the last 2 days where crude oil has dropped into the mid $70 per barrel range. Natural gas prices are under $4 per million BTU. These are, this has let a lot of the air out and the concern for higher commodity prices here in the middle of winter. And it's really beginning and ending with concerns about the economy, and people need to, I guess, reflect on the fact that the primary thing that affects oil right now, it's supply-demand fundamentals, but oil trading is a financial asset right now, as we've been on the heels in the United States of a lot of interest rate increases that have increased the expectations for slowing of broader economic activity toward recession. And to be clear, the US and Europe have almost single-handedly pushed towards an economic recession with these rate increases. But it's a question mark and an uncertainty about how much of this is already factored in globally. The slowing that's been occurring in China and other emerging markets has largely shown some signs of holding up. And when we look at a global basis, the latest IMF headlines that are coming out reflect an outlook that still shows growth of about 2% for this year. 2% global growth historically means that you need about 1 million barrels per day more new oil, more energy this year than you did last year, and about 3 billion cubic feet per day globally, more natural gas this year than last year. So let's be clear, even slow economic growth has historically implied needs for more energy, not less. And once we get through some of the noise in the markets, that underlying supply demand fundamental about understanding that demand isn't just growing, but it's historically high. By the official estimates, we're talking record levels of global oil demand, tying the record this year based on estimates from both the IEA, the International Energy Agency, and the US Energy Information Administration. So close to 101 million barrels per day. Both in the fourth quarter per IEA, and that's the expectation at that level annually for EIA this next year. Side by side, there's an important comparison right now between natural gas, which I'm not going to talk so much about, and my colleague Rob Jennings will. But natural gas has zoomed back, and we've cut the prices in half in the United States in a little over 2 months. We've seen prices go from $9 and $10 per million BTU to under $4 per million BTU here recently, looking out the window. And that's happened because storage went in the shoulder season just before any evidence of a cold winter from being in relatively short supply and below its historic 5-year range to catching up rapidly, seeing drilling activity accelerate beyond pre-pandemic levels. All of this happened in a very short period that changed the expectations in the price environment. And side by side with oil, we haven't seen the same kind of catch-up effect in terms of drilling, production, investment. Here shown on this slide, $58 billion of capital investment industry-wide for the latest quarter for which we have complete financial reporting, which is the third quarter. That compares in 2019 to a pace of over 70 billion a quarter. And this is largely global investment. We'll unpack some of this in another slide or two. But to keep in mind that if you're going well below, you can't get something for nothing here. And we have less investment that we've had, despite the fact that the economy has come back, the expectations for recession, yet continued demand growth open up a gap in these primary data that I talked about that we've been discussing for really a year and a half, that demand has come back with the economy since the pandemic, but the supply has continued to lag. And in the United States, where the supply has been relatively lower than demand, we've continued to draw down the inventories to the tune of the Strategic Petroleum Reserve of over 1 million barrels per day over the last half of the past year, and another 500,000 barrels per day on a global basis. Other so-called IEA or allied International Energy Agency member countries that, along with the US, have released 1.5 million barrels per day total, roughly over the last 6 months. And that equates to about 1.5% of the market. So it may not be evident when we look out the window this morning and we see prices having dropped, that's at all indicative of a market that's not well supplied. With the continued inventory releases that has been well supplied, but OPEC has cut back in the amount it's supplying, effective as of November, by 2 million barrels per day. Coming into December and then into early this year, you have the implementation of a price cap plan that reduces the amount of supply that Russia is putting or able to put on market. And on top of this, now you have the continued demand growth that we mentioned along with the economy. In the United States, the underlying fundamentals of productivity and what's happening in the field have continued to slow year on year. So by EIA estimates, rig productivity is down about 20%. All of this comes back to this theme of, for the dollar, you can't get something for nothing at a time when cost escalations continue to rise. And that's led OPEC, Saudi Arabia, and the International Energy Agency each to say recently that they don't think the amount of supply will be sufficient for this year, despite the fact that we've been lulled into what seems like a lower price looking out the window today. And the side by side again, natural gas having zoomed back and oil not so much in the United States, raises this question of whether the lowest strategic petroleum reserves in 40 years are sufficient in an environment where the demand continues to grow. So those are the key takeaways I'm going to hit just key slides that reinforce these concepts. The amount of investment we track at API, both as a flow over time by quarter here shown on the left, and as a stock or backlog of projects on the right. The amount of investment that goes in the different shades of green here, we separate our industry into different segments and think of resource development is the upstream. So think of taking things that are underground, drilling, producing them, exploring, all of that activity. And global companies that have large resource development segments are what's shown in green. That is the vast majority of the industry's investment. And that's not to say that the refining and petrochemical and pipeline transportation and export facilities, these are massive multi-billion-dollar investments, right? But they compare or just are dwarfed in the scale of how much is necessary capital-wise to develop resources globally. If we're comparing the 58 billion for the last quarter, that compares to 41 billion 1 year ago for the same quarter. So it's up a lot. But cost escalation, if we look to the US Bureau of Labor Statistics, for example, that tracks producer price inflation in the United States, we saw it coming into the fourth quarter where that producer price inflation was as high as almost 48% year on year. So it takes more spend to just try to tread water here. At the same time, comparing back over time, this compares with over 70 billion a quarter in 2019. If we went back to 2015, this is like half of the historic spend. So the numbers are up, they've gone the right direction. And over the last year, we've continued to see the activity level increase. It's just not where it has been historically to continue to produce supply necessary to meet demand that's near record levels. In terms of the backlog of projects, this picked up markedly, and this shows that there's an appetite for investing in the United States, large multi-billion-dollar capital projects, including liquefied natural gas export facilities, refinery expansions, petrochemical expansions, and new pipelines. $218 billion worth of these projects in the fourth quarter. That compares with 158 billion in the prior quarter. So a lot of what we call affirmative final investment decisions being taken to invest tens of billions of dollars at a time in these projects, but enabling these projects and the ability to construct them in an environment where cost escalation has remained high is one of the key challenges. The amount of drilling activity has historically tracked prices. And I just mentioned that the crude oil prices, and just looking out the window the last couple of days, have dropped into the mid 70s. These are futures prices for year ahead delivery. They tend to be a little bit more stable. It's on a rolling basis. And historically, that's been a good leading indicator of where global drilling activity would go, shown here from Baker Hughes for US and international oil and gas drilling. Since 2020, you see the gap that's opened up. The prices have come back just fine. And even if we're going into the 70 to 80 dollar per barrel range on a futures basis here, it's still showing a gap versus where drilling actually is. So we need this to catch up, to continue to be a leading indicator of where the activity level actually supports supply to be consistent with the demand. When we look at the segmentation of it in the top as of November, the latest data, you see of the four categories of US and international oil and gas, only US gas drilling is the one that's exceeding its pre-pandemic levels. US oil drilling is still down more than 8% compared to pre-pandemic levels, international drilling even more. I've mentioned that oil demand, energy demand goes along with the economy. I'd like you to see it here. So the size of the global economy is on the horizontal axis. The amount of global oil demand is on the vertical axis here. And from year 2000 until 2019, this is almost a straight line. Even the great financial crisis was just a blip on this scale. You see the downturn in 2020 with shutting down for the first time explicitly certain segments of the economy and what that did to oil consumption. And then the actual recovery by EIA's estimates for 2021 last year, and now the expectation for this year. So 2 points. First, left to right on this scale. Notice that the 2021 point, so 2 years ago now, was larger. The economy was larger than it was pre-pandemic in 2019. Think how brutally the Obama administration was criticized in the United States after that great financial crisis in 2008 and 9, where for years it took the economy a lot more than 1 year to get beyond its great financial crisis levels. But on the heels of more than $20 trillion worth of global economic stimulus, in 1 year, the global economy exceeded its pre-pandemic size. That's remarkable. It's unprecedented in terms of the amount of stimulus, and we should have expected price inflation to come with it. And that's the key challenge that we have right now, is that price inflation had picked up to over 8% last year. That's meant that central banks around the world have raised interest rates to try to stem or slow that rate of price inflation. And the US Federal Reserve continues to signal that it's going to raise rates to stop price inflation at almost any cost here. So this is the backdrop coming into the first quarter of this year, where there's an expectation that Fed will continue to raise at least 50 basis points or 0.5% this quarter. We'll see how that plays out. The second point I want to leave you with is the amount of global oil demand. I mentioned that it's rising by both IEA and EIA expectations toward record levels. You see it here with the average for 2023 at almost 101 million barrels per day. Now, you can't have an outlook without showing some sort of price to go with it. This is EIA's expectation together with the history for international oil prices in red, and then their expectation going out to the end of this year. What's overlaid with this is the supply-demand balance. So globally in darker blue, and for the United States in lighter blue. And the way to think of this is when supply was greatly outstripping the amount of demand, as we had during the downturn in 2020 and the pandemic. Right in the middle, you see that was downward pressure on prices. And since then, as the economy has strengthened and supply has failed to keep up with the pace of demand growth, as you see since really mid to late 2020, we had 10 consecutive quarters actually in the United States of drawing down inventories. And as you draw down and rely on your inventories and your supply is not keeping up with the demand, that's tended to support prices. That brings us up to recently, where we've continued to have the stock drawdowns, but you notice the prices have slowed recently. Well, why is that? That's oil trading again as a financial asset, as a recession has been priced in here. And the expectation now, as the clouds clear on this, should continue to show that if you don't have a balanced market, if you continue to draw down inventories, that's historically supported prices here. In the United States now, we can zero in on by fuel what the demand is. The historic data, our data, high frequency data by fuel now shown on the right-hand side together with projections from the US Energy Information Administration. And just ask yourself, when's the last time you saw a recession with close to full employment? And with this fuel outlook, which from EIA is quite solid and close to record levels for the United States, ask yourself, does that look like a recession? Does that look like 2020? And the answer is intellectually, no, it doesn't. And when we look at the high frequency indicators by fuel of flight activity, manufacturing activity, petrochemical activity, how much people are traveling, how much freight is going by air and by truck, all of these indicators as of the end of late last year in the fourth quarter were up year on year. So this says the underlying economic things that we look at, both as fuel indicators and the activity indicators that lead to that, have remained underlying solid, resilient along with the economy. So again, the headline of the day may be pricing in a recession, but we're not seeing that show up in the fuels data at this point. Inventories I mentioned, and having drawn those down over time. This is the US zooming in, and I mentioned 10 consecutive quarters of drawdowns. Well, on the US, there are two types of inventories here. We can take commercial, private company inventories, and then government controlled or strategic petroleum reserves. The private inventories are shown on the left, and they had been below their historic 5-year range. That's the red, tracking month by month through year 2022. And then at the bottom of the 5-year range toward the end of the year. And then the US Strategic Petroleum Reserve is the one where, on a very different scale here, has been drawn down to historic proportions. So just in the last half of the year, 180 million barrel drawdown, 1 million barrels per day over 6 months, well below its 5-year range. And to put this in context, the level of the SPR, which is our insurance policy against global disruptions in crude oil supplies, is at its lowest level now since February 1984, so almost 40 years. And if we're comparing back to 1984, consumption as a nation is more than 29% higher this last year than it was in 1984. So policymaker, why are you comfortable with the lowest reserves in almost 40 years against the backdrop when our consumption, our national consumption is so much higher? That is the policy question that has to be asked at this time. Now, another of the headlines that's been coming since really last summer is what's been happening with gasoline prices. Shown here for Maryland, the US average for gasoline prices, so in white and red on the right respectively, relative to crude oil prices. And regardless of the call starting in July from the Biden administration to investigate price gouging for gasoline prices, look, on a monthly basis, relative to the official reporting here from EIA of refiners, what they pay on a composite basis for crude oil, you see the blue, the red, and the white, they've gone in lockstep. And Maryland's prices have been about on par with the US average. That's consistent. It's evident both in the pattern here that we see on a monthly basis that you don't have to look much further than crude oil prices to understand the price of gasoline. Straight up, per EIA's estimates as shown on the left, more than half of the price at the pump is crude oil. But if we're looking at the changes year on year and just trying to explain, well, tell me, as crude oil went up for a lot of last year and then has come down recently, what's happening with the price at the pump? More than 70% of the changes last year were explained fully by the changes in the price in crude oil, and it's substantially all of it for Maryland, actually. So this is important because it means getting rid of a lot of the political rhetoric that led up to the midterm elections in November. We really, if we understand having abundant reserves, abundant production, keeping downward pressure on crude oil, that's the key to keeping prices at the pump historically under control here. And if we separate out now gasoline versus diesel fuel versus propane, as a heating fuel, this is a question or a chart quickly of the stocks, the 5-year averages, and then the last 2 years of data. Take gasoline, slightly below the 5-year average, but not by much. Distillates, much more so. And there's been a global shortage of diesel fuel and heating oil. Distillates have been in short supply due to Russia's war in Ukraine, and there's been price pressure both in the US and globally as a result of that. So distillates notwithstanding, that and the supply of it on the East Coast coming into winter has been a prime concern. Propane here is toward the top of the 5-year range, not so much of a concern, but really important to agribusiness to make sure that local supplies are there. Let's focus on distillates because the US East Coast consumes on an annual basis roughly 1.2 million barrels per day of distillates. About a little over 200,000 barrels per day of that is produced by refiners within the region. The European trade, the trade from international refiners coming into the East Coast, in the latest data that we had last year, was down 40% year on year. So amid that global crisis and energy shortage, it's been hard to attract the imports that the region historically depended upon. Relatively more supply has come from the Midwest refineries, but that's small on the scale of things. And it's really the Gulf Coast that's the key. The Gulf Coast has historically sent about 800,000 barrels per day out of that 1.2 million barrels per day to the East Coast. And how it gets there then becomes the issue. Refiners have been running almost flat out, close to 95% utilization rates. They've stepped up in the amount, both in the Midwest and the Gulf Coast, that have been produced of all fuels, but especially distillates here in the amount that has come. But the ability to ship it, if it's going to come from the US Gulf Coast to here in Maryland, it's either coming up the Colonial Pipeline, it's moving up a barge on the Mississippi River and then over by truck or rail, or it's coming by truck or rail straight up. Or lastly, a lot of this comes by ship and then it can come into New York Harbor or other places. And the shipping part is subject to Jones Act restrictions. So it has to be a US manufactured, flagged and crewed ship at that point. And I will tell you, having gone to a conference in Houston late November, where I got an earful from some of the suppliers saying they were trying to get Jones Act compliant ships, not just now, but out to year 2026, and they can't get them. So there are limitations there. And if we get into, it doesn't look like an issue right now, but if you got into a corner where amid a cold snap, you really needed to get more supply quickly, a very targeted waiver for one set of products from Gulf Coast to East Coast for a limited time period would be the way to work around that from a policy standpoint. But the silver lining here is that the inventories have picked up markedly. So the Biden administration, Secretary Granholm had been threatening to ban exports of distillates from the United States to try to address the shortage on the East Coast. That's like using potentially a shotgun to kill a fly here, right? It's not a very fit for purpose targeted policy solution. Again, you can address the logistics issues. But we went from having fewer than 25 days of supply in the United States a couple of months ago to now with refiners having stepped up close to 32 days of supply, close to the historic norms for this. So that's on a nationwide basis, whereas the charts I'm showing you here are just for the Central Atlantic region. But it suggests that on a nationwide basis, the supply of distillates is adequate. It's just a question of getting it to the region in a targeted way. So that's the issue du jour. The broader context is that as the economy comes back, even with these concerns for recession, it sure looks like there's a continued demand growth for both oil and natural gas that's going to be important. We're going to need to continue to work through all the supply chain, workforce, financial, and policy issues that affected supply, both in our industry and so many others. Project execution, continuing to meet our international commitments that are being made and grow these multi-billion-dollar projects. That's going to be key, because if we can't do that, then you can't have the continued supply to the rest of the world without it becoming a boiling frog syndrome for US consumers. So supporting the value chain, supporting cogent policies that are well thought out through the value chain is really important. And then having an insurance policy, again, reiterating that we've got the lowest strategic petroleum reserves in nearly 40 years, doesn't leave a lot of margin for error if we continue to see demand growth this year as expected. So I'll end there and welcome questions.
Okay, we don't have any questions yet, but we'll definitely have time at the end. So we can go right to Rob now for his presentation.
Sounds good. Thanks, Dean. Thanks, Mary. Good morning, everyone. I've got a set of slides to share as well. Mary, can you confirm that you can see me?
I can see your slides and you.
Okay, great. Great. Okay, so thanks to Dean for giving us the macroeconomic and the oil outlook. I'm going to turn a little bit more to the natural gas market side of things. It's obviously been a very volatile 12 or so months in natural gas markets. This began really with the curtailment of natural gas pipeline flows into Europe, which resulted in a global energy crisis, really. So I'm going to start with kind of the global picture and then drill down into the US picture and some regional issues we're seeing. So first and foremost, I mentioned the global gas market has been extremely tight. So what you're looking at here are natural gas prices around the globe stretching back about 12 months, so the beginning of 2022. One reminder here, unlike the oil market, there's not one single benchmark for global natural gas prices, but rather we look at three. First is in Europe is TTF, the Tidal Transfer Facility in the Netherlands. In Asia, we have the Japan-Korea marker. And then of course, in the US, we have Henry Hub. So you can see, again, it's been a very volatile year, especially for the global benchmarks. This began when Russia, really in the summer of 2021, Russia began curtailing natural gas pipeline flows into Europe. That sent global prices soaring. They ended up invading Ukraine around the end of February of last year, so about 11 months ago, 10 or 11 months ago. And you can see how the global market reacted. Prices in Europe, that's the red line, and prices in Asia, the blue line, spiked up to $50 to $70 per MMBTU, which is 5 to 7 times the historical average. They came off a little bit after that, but then really in the second half of 2022, Russia turned up the heat and really began curtailing pipeline flows. I think you probably saw the headline, the Nord Stream 1 pipeline, which is one of the largest pipelines in the world connecting Russia with Germany, was shut down. That sent prices in Europe up to $100 per million BTU. For those of you that think better in terms of barrels of oil, that's about $580 per barrel of oil or $25 per gallon of gasoline. So really unthinkably high prices. That being said, they have fallen over the past several months, and we'll get into that a little bit more later. But another thing to point out here is that Historically, Asian prices, that Asian marker, JKM, has traded at a premium to European prices, but you'll notice over the past year that has flipped and Europe is traded at a premium. What happened was once prices exceeded roughly the 25 to $30 per MMBTU mark, Asia got priced out of the market, and what they ended up doing was turning back to coal in a big way. So all indications are that China and the world likely set an all-time high for coal consumption last year. And we'll get into that a little bit more later as well. Now, let's turn to the US, all the way down there, the green line at the bottom. As my boss likes to say, this is what energy security looks like. The United States is the largest producer of natural gas in the world. Roughly 1 out of every 4 molecules of gas produced each day happens right here in the US. This has allowed us to remain insulated from the global volatility that we've seen. And this is, again, you can see our prices have, while they have been higher, slightly higher than the past 10 years or so, they are still remarkably lower than the rest of the world has seen. So how did we get here? Well, as I mentioned, Russia officially weaponized its gas supply. So what you're looking at on the right is a map showing all of the natural gas pipeline connections from Russia into Europe. And each of the red X's represents a pipeline or a country that has been cut off over the last 18 or so months. So historically, the European Union imported about 40% of its gas supply from Russia. That equated to about 15 billion cubic feet per day, but that's been sharply reduced. Most recently, again, the Nord Stream 1 pipeline, which is almost 6 billion cubic feet per day, was cut off. That happened at the end of September and coincided with the run up to $100 per MMBTU. Here we are, it's January 4th. There is still tremendous fear in Europe that they could be short on natural gas, but they have been blessed with a very warm fall and a warm start to winter. That's allowed them to rebuild storage inventories. The higher prices have allowed us to redirect LNG cargoes to them, and they are in a much better position, I think, than most people thought they would be on January 4th of 2023. That being said, there are still 2 or 3 months left of winter. So a cold front in Europe coinciding with a cold front in Asia could bring some more economic pain to these countries. But again, they're in better shape than most thought they would be. But just to underscore, this shift, this realignment of gas flows is the biggest that we've ever seen in global markets. You can tell from this map that all of Europe's energy infrastructure was designed to move energy from east to west, from Russia into Europe. Those pipelines are now useless. What Europe is having to scramble to do is build LNG regasification capacities so that they can import the liquefied natural gas from suppliers like the US that they need to meet their demand this winter. So what has our response been? Well, we've sent them an armada of LNG. This is a screen grab showing, I think this is back in September, a real-time look at all of the LNG cargoes leaving the US Gulf Coast and heading to Europe. The US is the largest exporter of liquefied natural gas in the world. Again, we're about 25% of the market. And so what we've been able to do is really support our allies. And one of the reasons we've been able to do that is that the LNG export contracts in the US are very unique and that they are destination flexible. Effectively, what that means is the buyers of the LNG take ownership of it at the export facility, say on the Gulf Coast, or you even have one there at Cove Point in Maryland. And then they can decide where to send that natural gas. So typically they'll send it to the highest price region. If you think back to the first slide, over the past year, the highest price region has been Europe. So that flexibility has really allowed us to support our allies in this time of crisis. But again, this is a generational shift in global energy flows, and the only way to solve this in the near to midterm is a massive expansion of the US LNG export fleet, and we need the right federal policies in place to do so. I'll pause there for a minute before jumping into the domestic side to see if there are any questions. Mary, did we have anything come through?
We did. It's from Matt Hauser. It said, he asks, seems like supply and demand is the basis for all economic issues. Does the US reserve include distillates or just gasoline?
I think that's probably a question for Dean, so I'll turn it over to Dean.
So the Strategic Petroleum Reserve is actually only crude oil. In the Northeast, there is 1 million barrels of product reserves, but for the most part, the SPR and any substantial amount of supply, it's purely crude oil on the historic premise that we have such a strong refining industry in the US that we can turn crude oil into whatever products we need in relatively short order. And that premise is right, so long as you're willing to, it dates back to the time before we were such a major exporter of both crude oil and refined products. And this debate about whether you ban exports, if you're willing to play that card, you can't promise to support allies during a time of war during that. And the sufficiency of it then, and API doesn't really have a policy on what the right amount of SPR is here. All we could observe is that it's at historic lows at a time that our demand's near record highs.
Thank you, Dr. Foreman.
Absolutely.
We do have one more question here from Julie McCoy. Is there a clear-cut reason for prices being noticeably higher at the pump in Allegheny and Garrett counties as compared to Hagerstown and Frederick and further east?
We'd really have to look at the local conditions to understand it, and over time as well. Sometimes individual stations, even within metropolitan areas, can vary. There's a theory that the term is rockets and feathers, right? Things historically go up more and faster than they tend to go down. And when things go up, the station, and keep in mind that 97% of these gasoline stations are independently owned and operated. They're setting their own prices, but they're acutely aware from a local business standpoint of what their cash flows are and what the cost of the next cargo going is going to be to replace the fuel that has to go back into the tank. So on that basis, when crude oil prices go up, the futures markets go up, you see almost real time that the price at the pump can seem to rise in that way. And then when the prices start going back down, as they have in recent days, if that continues, it takes a degree of local competition for that to drive down. So I've gotten questions, for example, of, why is it that you would see a lower price in Key West, Florida than you would in downtown Miami sometimes? And the location and the convenience of a station, how price sensitive the consumers are, and whether they're willing and able in a very congested area to drive, or if it's not a congested area, if you're out in rural Maryland, how far are you willing to go to save just a couple of pennies per gallon? These things come into play, and then the nature of competition of whether you have big box retailers that might use, a Costco or a Sam's, use gasoline as a loss leader to try to get people in the door. Keep in mind that most of these businesses, they may make more money off of selling coffee than they actually do off of gasoline. So getting foot traffic is another element of thinking in a retail business model. All of this is to say that there are a lot of reasons why you can see local price variation, and whether or not people are trying to use it as a way of attracting customers into their business. Over time, though, have no doubt, you saw that US and Maryland prices are really close on average, and that's really a strong reflection of the underlying price of crude oil. So if crude oil prices are coming down and that continues, likely that's downward pressure on what you'll see at the pump.
Okay. Okay, thank you very much, Dr. Foreman. We have another question from B. Barkley. What exactly is the difference between distillates and gasoline?
Sure. So think of it as you've got different fuels for different purposes, but the simplest way of refining crude oil into products is basically boiling it, and you bring it to its boiling point, and then different products effectively, as the vapors rise and you're boiling it, they condense at different levels, and the lightest ends of it go super high. Gasoline is a lighter fuel than the distillates, the middle distillates are. So you've got gasoline, then you get jet fuel after that, and then you have things like diesel fuel, and then heating oil is even heavier than that slightly, and the amount of sulfur also. So sulfur content and the density of these fuels, and hence their energy density, also varies. So gasoline tends to be relatively lighter and cleaner and burn cleaner than diesel fuel. Historically, we've been regulating out sulfur from diesel fuel, so that's come down into a lower spec for that. But it really is just naturally, as you separate oil, you get different products off of that, and then they've developed different purposes for it. So gasoline is ideal for a lot of light duty transportation, small motors, diesel fuel for Class 8 diesel trucks, larger engines, marine bunker fuels, things like that. So you can use it, and we see it as a home heating application as well, where diesel, distillates, heating oil are all low sulfur now today and used universally. So I hope that helps, and feel free to follow up if you have more questions.
Okay. I have two more questions, and then we'll get back to you, Rob. Okay. So Mike Rolfs that asks, news reports mention leases versus permit approvals, royalties, environmental checks, which have caused some oil price increases. What specific policies do you think have affected the oil prices the most?
Well, I mean, actually monetary policy recently, again, trading as a financial asset and pricing and expectations of recession have been kind of the primary impact. Workforce, supply chain, and financial issues, as well as policy issues, have all had an impact on prices over the last year to 2 years. In terms of specific policies, the leasing and permitting issue is important because when we talk about US oil supply not having come back quickly, access, if think of it, you're planning a business and let's say you're going to have to build a gathering system. When you drill these individual wells, you have to put pipe in the ground to gather things and then move it. You have to have commercial contracts in place to deal with all of that, both for the oil services, the drilling, the completion of these wells, the tying in of all of this, and then the processing of the facilities to move it. And then this is before you ever translate it into a fuel, right? So if I don't have 3 to 5 years worth of drilling sites lined up, it's hard for me to make a decision about committing the capital on a risk basis to go say, I'm committed to growing in this area. And whereas, natural gas is zoomed back, right? All of those policy issues that we talked about affect oil and gas in the United States, but yet gas has come back and oil really hasn't. And the side by side on that is that gas has succeeded because it's really 2 states. It's Louisiana and Texas that have led here. They have relatively favorable business climates, good infrastructure. They've moved forward and have just been hitting on all cylinders. Where with oil, it takes a proverbial village of states in the United States. It's a lot more states and broad-based in production. So the Permian Basin area of Texas has been hitting on all cylinders and doing well. But if you cross the border into New Mexico, not so much. Its drilling activity is still below pre-pandemic levels. The federal leasing issue is really important there. Colorado has literally taken a powder here, so well below pre-pandemic levels in terms of drilling. Production off, better part of 200,000 barrels per day. Literally just Colorado by itself is like equivalent to, what we've lost there is equivalent to about 1/5 of what we've been taking out of the Strategic Petroleum Reserve over the last year. North Dakota, Wyoming, also below pre-pandemic drilling levels, similar kinds of issues here. So access to resources is one. The ability to build interstate pipelines is number 2. The steel tariffs that have been in place have limited access to certain kinds of equipment and or raised the cost of it. And the cost of drilling and completions is hence up. In most industries, you think of costs as determining price. In this industry for oil and gas, prices tend to redetermine the costs, and there's a feedback loop that goes with that. And the producer price inflation that was so high coming into the 4th quarter, again, I mentioned for oil and gas extraction by BLS estimates, almost 48% year on year. These are the kinds of things that intertwine with the policy environment. So you really ask yourself, from a longer run perspective, if the Biden administration signals that I want you out of business, off of oil, off of natural gas by 2030 or 2035, what are the incentives that you're going to invest a lot in assets that have to live for 15, 20, 25 years? And that's another impediment to investing here. So getting everybody on the same page, understanding that we accept that there's a climate imperative and that there's an energy transition that's ongoing, but we need to continue to have investment in the things that, here's the way to put it, that there is no sustainable path to decarbonization unless consumers have affordable fuels along the way. And if we're sharing those goals, we have to share in the investment in the path that makes it so that we have a healthy economy along the way. So I hope that answers. It's a few different threads to it. Again, please feel free to follow up if you have more questions.
Very interesting. Thank you very much. I'd love to have you come to Annapolis and talk to a few people around here.
Glad to.
So also
I'm a
Matt
Maryland resident. So.
So Matt Hauser, one more question before we go back to Rob. I didn't see any weather events on the charts. When a hurricane affects the Gulf offshore operations and onshore refineries shut down, then we hear on the news that gas prices will increase. Isn't that a somewhat exaggerated overreaction to what seems to be a complex supply chain problem? Rob or Dr. Foreman?
Well, yes and no. I guess I'd like to acknowledge that there's a valid point that sometimes these things, based on the uncertainty of what a hurricane could be, affect markets in ways that aren't altogether clear. And then when you get data that, for example, after the hurricanes in 2021 show that something's offline, how much oil and gas production's actually offline and for how long, if it's, again, if the supply is disrupted in some way, starting from the upstream all the way through the processing of it into fuels, the futures markets, financial markets are where these broad markets are the price setters, right? It's not the individual producers or refiners or anybody else in that value chain that's setting the price. They're price takers. So as the system works and the market sets this, it uses all available information. And if it looks like something is short of supply, it generally takes a higher price to motivate the market to shift supply to go serve those areas. So that's, in short, the more information transparency you have in the way that works, as hurricanes are coming, I think the industry's done a good job of cooperating with the affected states to try to make it as transparent as possible, to get waivers as needed to make sure the product is moving to mitigate those both supply and price impacts. I think we've had a lot of success stories actually of working public-private cooperation to make sure that through emergency situations that's been managed well. That said, the hurricanes, where you get something, a Hurricane Katrina kind of disruption, or a hurricane that swamps and takes things out for weeks at a time, can have a larger impact, and we need to see. Winter storms, we haven't seen any kind of major disruptions again this year like we did in the Southwest last year. Fingers crossed, let's hope that that's truly a 100-year storm. But as systems work better and the integration and the importance of this into the power sector, which, to segue back to Rob here, the reason we have a lot of uncertainty about the demand, by the way, for oil, even on the global level between the official agencies, there's a 1 million barrel per day discrepancy now, just as a note, between the US estimates and the International Energy Agency estimates, simply based on how much shortage there is globally of natural gas and how much distillates will be used for power generation around the world. That's really important in Asia and other places. And this all comes back to tying together our weather events with global supply chain issues. This connectivity between local issues and global issues is really important for energy markets.
Thank you very much. So we'll take the rest of the questions when Rob is finished. So I'm going to pass it back to you, Rob. Thanks,
Mary. Okay, so we've wrapped up the global section here. And again, I like to start with this because this global energy shortage we have is serving as a backdrop to everything that's happening here in the US in terms of climate policy and energy policy. So I do think it's relevant, but let's jump into the domestic market. So I mentioned that the US's status as the largest natural gas producer in the world has kept us insulated from the global volatility that the rest of the world, especially Europe, has been facing for the past year or so, but we haven't been fully insulated. So over on the left here, you'll see a chart showing Henry Hub prices. Again, that's the US benchmark down in the Gulf Coast, stretching back about 15 years. And you will notice a pretty remarkable period of stability starting around the beginning of 2010 and stretching for the next 10 years. That was the shale revolution. That's when we learned how to very efficiently extract natural gas and oil from rock. This gave us untold benefits, emission reductions, falling electricity prices, industrial growth, increased global competitiveness. It gave us energy security and made us a net exporter of energy for the first time in 50 years. But you'll notice for the past 18 months or so, a supply-demand imbalance has emerged that drove prices to levels we haven't seen since the Great Financial Crisis. You have to go all the way back to July 2008 to find the last time that prices hit that $10 mark that we came very close to in August of 2022. So again, this is a supply-demand mismatch that's emerged. I think one of the questions sort of prompted this. And it really came from very strong growth in demand for natural gas, combined with what I'll call sluggish production growth, especially in the first half of 2022. So to dig in a little bit further, over on the right, we have the year-over-year change in natural gas demand broken out by sector. And while the headlines that you've probably seen over the past year are that our growing LNG exports are what are driving natural gas prices higher, if you actually look at the data, the power sector has been far and away the biggest contributor to growing natural gas demand over the past 12 months. So the power sector has accounted for about 60% of the growth. And the reason for that is twofold. First and foremost, we had a hot summer, frankly. People were using their air conditioners more so than in a typical year. So that was more use of natural gas in the power sector. And then at the same time, typically over the past 10 or 15 years, utilities have been able to, when natural gas prices exceed, call it $4 or $5 per million BTU, they've been able to shift back to coal for power generation. That has acted as sort of a soft cap on natural gas prices. But what doesn't get talked about as much is that the global coal market and the domestic coal market is also extremely tight. Those prices are also at 15-year highs. So that's risen that break-even level from switching from natural gas to coal up towards $8 to $9 per MMBTU. So that's kept a lot more gas in the power sector and contributed to that growth, about 2.5 billion cubic feet per day a year. Now, that said, we did bring on 2 new LNG export facilities, and that contributed to about 1.2 billion cubic feet per day of additional demand from that sector. Both of those facilities were down in Louisiana. But again, as a whole, on the whole, the power sector was the biggest contributor to growth. So now on the supply side, this is a chart over on the left showing daily natural gas production for the past 3 years. The red line is 2020. It's pretty clear when the pandemic hit and cratered demand for natural gas and therefore cratered supply of natural gas. The blue line is 2021. You can see in the early part of the year in February when Winter Storm Uri took a lot of production offline in Texas. And then the green line is 2022. And you can see we started 2022 around 93, 94 billion cubic feet per day, but then stayed really in that range for the first 6 months of the year, despite natural gas prices running up towards decade highs, 15-year highs, really. And the reason for that is multifold. First and foremost, the industry saw the same labor and supply chain constraints that basically every other commodity, every other industry saw over the past year. That hurt our ability to increase production. But I think the bigger reason for this was infrastructure challenges. It's become very difficult to build a pipeline in this country. As it's pertinent to the Mid-Atlantic, the Appalachian Basin, that's the combination of the Marcellus and Utica shale plays, is the biggest and most prolific basin in the country. But since we can't build a pipeline out of that region, we have been unable to grow more production. And I'll get to that on a later slide. But again, these infrastructure challenges make it difficult for us to ramp up production despite prices being at record highs. So that being said, the second half of the year, the industry showed up and production roared to record highs. So you'll notice in the second half of 2022 on the green line, production ramped up to close to 100 billion cubic feet per day. That's a record. The EIA estimates that 2022 as a whole will be a record for natural gas production. So the industry really responded to the high prices. That has contributed to the decline that we saw that Dean mentioned in Henry Hub prices over the past several months. They peaked close to $10 per MMBTU, but as of yesterday, we're down to about $4 per MMBTU. So that's a pretty remarkable 60% decline. That being said, almost all of the growth for the past several months has come from the Permian and Haynesville basins. The Permian, of course, is in West Texas and New Mexico, and the Haynesville's in East Texas and Louisiana. Those are regions that have sufficient pipeline takeaway capacity, unlike the Appalachian Basin, which has really been constricted by the lack of pipelines here. So where does that leave us? Well, for much of 2022, high demand and somewhat sluggish production growth left us with a storage deficit. So this is a chart that the Energy Information Administration publishes every Thursday morning, and it shows our working natural gas storage levels relative to the 5-year average. So the blue line is where we are in a given week, and the gray line, the dark gray line is the 5-year average. This is how the market thinks about our gas storage levels as relative to the 5-year average. So you can see that beginning around the start of 2022, the blue line was below the dark gray line. That denotes a storage deficit, and we spent a lot of 2022 below that gray line. This is the principal contributor to the high prices we saw. Now, again, that being said, if you look towards the end of the year, the blue line began to gravitate towards the gray line. That was a result of the growth in production that we ended up seeing out of the Permian and Haynesville. That allowed us to close our storage deficit and again contributed to the big decline in natural gas prices that we've seen really since the end of September. So digging back into this infrastructure constraint that I mentioned, over on the left is a map of the Appalachian Basin. Again, that's the combination of the Marcellus and Utica shale plays. And then each of the blue arrows is a pipeline that has either been canceled or delayed over the past 5 years. So the Constitution Pipeline, the Pennies Pipeline, the Atlantic Coast Pipeline, and the Mountain Valley Pipeline, which I'm sure you guys have seen in the headlines. These have all been canceled for various reasons, whether they're caught up in the courts, whether they had a regulatory issue, whatever it may be. But what that has done is, now if you turn your attention to the chart on the right, this is dry gas production, natural gas production out of that basin, which grew like gangbusters for the first decade. This basin really went from producing nothing to producing 1 out of every 3 molecules of natural gas in the US in just a decade. Very remarkable growth. But over the past 2 or 3 years, that growth has been stifled. We went from growing at about 3 billion cubic feet per day per year to growing less than 1 billion cubic feet per day or per year. And again, that's because we cannot build pipeline takeaway capacity out of that region to move natural gas where it needs to go. So how does that impact the market? This is a chart showing where the forward market was trading for 2023. So for this year, as of about a month ago, the red lines represent constrained regions. So of course, there's a constraint in New England that has long been a constraint. Their natural gas prices are trading close to $10 above Henry Hub. Out west, there's another constraint in California. That's really a storage constraint, but also very much a pipeline issue as well. Their prices are trading $2 above Henry Hub. But then if you look at the Southeast, this is a new constraint that has emerged over the past 6 months or so that we've been tracking. This is the result of our inability to get natural gas out of the Appalachian Basin into the Southeast where it's desperately needed. So what the market is trying to do there is price in as much coal as possible into the power sector. That's one of the consequences of not building pipeline infrastructure that doesn't get talked about nearly enough, is that it often results in utilities being forced to fall back onto dirtier generation sources like coal. So again, this is a supply-demand imbalance issue. Natural gas not being, again, driven by infrastructure constraints, natural gas not being allowed to get where it needs to go. It drives higher prices for consumers. So just to wrap up here, this is a graphical representation of an outlook that EIA publishes each October called the Winter Fuels Outlook. EIA projects what homeowners will spend to heat their homes each winter by region. So if you use natural gas to heat your home in the Northeast, the EIA expects that you'll spend an extra about $200 this winter. In the Midwest, $250. In the West, $190. In the South, about an extra $150. And if you are unfortunate enough to use heating oil to heat your home, EIA projects that you'll spend an extra $500 to heat your home this winter. And again, this is a direct result of the supply-demand imbalance that we saw emerge during the middle part of last year that drove natural gas prices higher. And this is how it really impacts consumers. And to be fair, some of these may be understated given some of the utility rate cases that we've seen being filed this year. In New England, we saw one utility request a 60% rate increase for natural gas to its customers. That's versus just 23% what EIA is reporting here. So again, this could be understated in certain regions. And then finally, just some key takeaways here. I mentioned it several times throughout the presentation, but infrastructure. We really need the ability in this country to build energy infrastructure to alleviate the bottlenecks that I mentioned, so we avoid the price spikes that we've seen. Some early indications, some early analysis that we've done indicates that the Biden administration has made these grand commitments to supply liquefied natural gas to Europe to support them in their energy shortage as a result of the invasion of Ukraine. We're going to need new interstate pipelines to support that goal while maintaining reasonable costs for energy in this country. So if we can't get that done, that's going to be a significant issue going forward. Second, market volatility. I mentioned this is a generational shift in global energy flows. We expect this volatility to continue, but as I mentioned, being the #1 gas producer in the world has its advantages. We are largely insulated from this global volatility. And then finally, but probably most importantly, what the industry needs most is policy certainty. And this is both at the federal and state level. We need consistent messaging around the role of natural gas amid the energy transition. That'll be key to establishing stability. And this doesn't just go for the natural gas and oil sector, but also for the power sector as well. So I'll wrap up there and turn it over to Mary and see if there are any questions.
Thank you so much, Rob. Yeah, we do. We're running out of time, but we have a couple questions. Dean, this one's for you. Do you see any new fiscal regimes coming to address new challenges related to cost, environment, and et cetera?
State or federal, I'm not sure. That's a pretty broad question. I
Yeah.
mean, the Inflation Reduction Act that was passed, I mean, is huge fiscal stimulus for addressing many renewable promotion and environmental issues, right? And potentially carbon capture, use, and storage as well, which if you think of emissions as fungible, meaning it doesn't matter whether I take carbon out of the atmosphere in one place or another, as long as it comes out, it has the same, wherever it is, it has the same environmental effect. So, you know, if we can continue to in an environmentally responsible way, develop and use fossil fuels, but offset that through carbon capture, use, and storage, so that, you know, net over time, these are the kinds of things where fiscal policy has an important role in incentivizing the development and the proliferation of that technology. So that's one, but separately, I don't see a fiscal package or something on the horizon that is evident that will, you know, greatly affect the path. It is worth noting, in the greater macroeconomic debate that's going on right now, there's a battle between fiscal and monetary policy, where monetary policy has been tightening and fiscal policy in many places has still been pretty generous, including the Inflation Reduction Act here in the United States. So that balance and where we go with it ends up being one of the key uncertainties for the year.
Okay, so we have another question from Russell Lacey. There seems to be a multi-front attack on USA natural gas infrastructure, from the pipeline fights to the city-states attempting to start banning natural gas as a heat cooking source. Is the natural gas pipeline industry in lockstep with a plan to fight back?
Yeah, lockstep, interesting. Yeah. So I mentioned, look, we've taken our biggest gas basin, the Appalachian Basin, the basin that really gave us everything, all of these tremendous benefits over the last decade, and we've really hamstrung it. I do think that the energy crisis in Europe and the global energy crisis has changed the conversation a bit on energy infrastructure. We've done a lot at FERC. I mean, essentially, FERC is the agency that needs to approve these natural gas pipelines, the interstate natural gas pipelines. So we've done a lot with them over the past year, just educating on, hey, look, we're going to need these things. You know, the president has made big commitments to our allies abroad. That's going to require these pipelines to get built. So I do think we do have, again, I'll call it a plan of attack to use your phrase, but I do think it's really more of an educational thing. Is that people don't recognize the benefits that we get from building these pipelines and the benefits that our resource base in the country gives us.
Right. Yes, you're absolutely right about that. Okay, and final question from Liz Bowman. Can you explain why is there a deficit in the natural gas storage? Is that due to the increase in LNG exports to Europe?
No, it's not due to that. No, I said, honestly, we've gotten that question for the last 9 months, really, since the prices began to run up. I think I had a slide, maybe my 4th or 5th slide, that showed the breakdown of demand increases for this year. And the power sector was far and away the biggest contributor to higher demand. So it's really, you have higher demand, and for the first 6 months of the year, supply just really didn't catch up. That was the principal contributor to lower natural gas in storage. Now we've roared back. Natural gas is very close to its 5-year average. The market has been happy about that. That's why prices have come down significantly. And to be clear, these LNG terminals are known years in advance. I mean, they're approved, and it takes 3 or 4 years to construct them. So the market sees them coming a mile away. They beget their own production. The Haynesville Basin in East Texas and Louisiana has really grown significantly to feed these LNG export terminals. So on their own, I mean, they are a large source of demand for us, but the industry has never struggled to keep up with growing demand for natural gas in this country until we've had these infrastructure constraints.
Okay, well, thank you very much. And for our audience, thank you very much. It looks like that is all we're going to have time for today. Many thanks to Dr. Dean Foreman, API's Chief Economist and Policy Advisor, Rob Jennings, for sharing your time and valuable insight with us. We will be sharing a recording of this webinar on our YouTube page later today, and we'll email that link out to all the attendees. Please feel free to share it. And again, I'm Mary Kane, President and CEO of the Maryland Chamber of Commerce. Thank you for joining us and have a great day.